we do?
All right, Garrett, you're going to want to share your screen so you can go through your slides. Wow, they really hated what the Fed had to say.
They haven't said anything.
Well, whatever it was, they hated it.
They just weren't positioned for it. It doesn't even make any sense.
Fed removes statement.
They just
reference,
let it go. They just sold. They're okay. Now we're bouncing back, and now the trade's on.
Yeah. Fed removes statement reference to additional rate adjustments. Inflation outlook rises.
I can't tell.
No, you're not live. I'm going to pull you guys off the stage, and then I'm going to run the countdown. Then I'll add you back in after the intro.
All right. Sounds good. Hello, everybody. I'm Mark Sebastian, your only option, and I'm joined by the one, the only Garrett Baldwin, our senior macro analyst and all-around brilliant guy when it comes to banking and stuff. We'll come up with an official title here soon.
You nailed it. We nailed it.
We got it.
Drove it completely out of Wrigley, bud.
That was that. Yeah. So apparently what we're reacting to is that they threw out all of paragraph 4. In assessing appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for economic outlook. The committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge. They threw that entire paragraph out. Like, this statement is a lot shorter, and it is a totally different statement from what the Fed put out, and markets are reacting in quite a negative fashion to this news.
Yeah, so we've given up quite a bit pretty quickly. We're down to 74.62. The line in the sand right now for funds is 7,500. We have been warning about this for the better part of a week, but let's just go through some data real quick. Core things just to note. If you look at the economic projections, which there are multiple things that you can assess if you are looking at what the Fed will release, you're going to see, well, let's just share this real quick because this is just real fun to watch. There you go. So that's just going to keep doing that. That's just a big red line that's just going to keep moving lower. This is really what you want to be looking at. This is the summary of economic projections. This came out at the exact same time. So everybody's excited about, you know, the fact that okay, this is a hawkish hold for the Fed, and the reason for that is these projections are very unfriendly. And if you look through them, and you doesn't take very long to assess this, remember we talked about the dot plot and what the expectations were. Fed fund median inflation has jumped 40 basis points for 2026, 50 basis points for 2027, 2028, 30 basis points longer run unchanged. That's the story. So the idea here is, are they going to have to raise interest rates come December? And that's kind of what the market will now start to price in. They're saying higher for longer is back on the table. So not forever, but definitely longer than markets wanted. The March path had funds drifting toward 3.1%. June is saying not so fast, cowboy. So right now, if you look at this, the PCE projections are way worse. You're talking 90 basis points increasing from 2.7 in March to 3.6. PCE next year up 10 basis points. And the core numbers go to 60 basis points and 30 basis points, 26 and 27 respectively. At the same time, GDP growth goes down. That's the other thing that's critical. So why does all this matter? Because inflation expectations up, growth projections down, and you can see
Hey,
that
Garrett,
here.
your backup mic is picking you up, not the one you're talking.
Oh, I
into right now.
apologize. That's not good at all.
We could hear you, but now we're going to
Well,
hear you.
now that's better. That should be better.
Right, yes. much
Okay,
better.
sorry. I know that everybody. Okay, we're just doing it on the fly. GDP numbers go to 2.2 from 2.4, 2.3 next year flat. So what you're looking at is a stagflation projection.
Oh, wow.
Right? That's what this is, and that's the problem. So the labor is holding. There's no urgency. There's no reason to cut. Again, the Fed has raised its inflation forecast. It's raised the rate path. It's barely changed employment. It still sees growth, but it's not a pivot. It's a pause with more or less brass knuckles. Now, the reason that we focus on this is what this reads is this is bad for bonds unless Warsh says the dots are stale and supply shock driven and not a commitment. It's bad for crowded equities if he validates the SEP numbers. It's potentially okay for cyclicals and financials because growth and employment are still fine. It's bad for immediate cut pricing. So the thing that is critical about this, Mark, and we are at the point right now where, again, I'm saying if you're going to try to trade this, and it's still very early
Yeah.
in this conversation, we have moved very far into the 4 standard deviation line. We are starting to see a little bit of a bounce. I don't like this simply because I would prefer to wait until until Warsh speaks. I'm still using bad habits from back in the day. Saying Powell's name. I would prefer to hear him speak and then start to set up for some sort of trade. But right now, the initial reaction to the market is not that solid. And I think for this, a lot of people have to understand what really is going on here, and it really comes down to positioning. So when they met today, it wasn't really about the announcement. We knew that there was not going to be any cut or hike today. Yes. What mattered was what the Fed does and then ultimately what the positioning was. So I'm just going to remind everybody, because this is important, because every year we have a huge meeting that typically takes place in June. We meet 6 times as the Fed meets. They're talking about potentially taking that down. But the key thing here is looking at this and understanding what they're actually doing and what they're trying to accomplish. The Federal Reserve is our central bank. They are in charge of effectively trying to manage the cost of interest, right? So again, the Forex markets are actually the cost of money, but the cost of doing business is largely set by the key interest rate by the Fed. They can raise the rate to fight inflation. They can also lower rates to cool it as well if we start to see a lack of inflation in the market. When the economy weakens, they cut rates to encourage borrowing and growth. That's the big narrative. They also try to promote jobs, right? They try to promote activity in the jobs market. So you have inflation that they focus on and you have the jobs market. Really, at the end of the day, their most important job is to provide stability to the financial system. We are the global reserve currency. They step in, they take action in the event that there are concerns around short-term lending. But overall, the actions that are set today are what we consider a pivot in terms of the expectation of what the central bank will do and how the market will react. So it's a lot to uncover. It's a lot to unfold, but you have to keep in mind a day like today resets expectations for the market, for large cap stocks. And as I note in this, why is this meeting so important? Warsh is going to speak. This is his first meeting. He may stop telegraphing if he doesn't like the way that the markets are operating. If he doesn't like some of these expectations, he's going to provide a different roadmap. And again, the conversation about inflation. He said back 2 months ago that inflation is a choice. If they don't fight it, that is a choice too. Now, we'll talk about the dot plot, but this is what you're seeing right now, and this is why it's so important to pay attention to these lines in the sand, 7,500. Going into this, all of the banks that we are looking at, analyzing and just looking at their risk assessment, they're saying ahead of time that the tone matters more than the forecasts themselves. Hedge funds are net equity exposure. It's one of the largest 1 month jumps we've seen on record. They are at a 4 month high. They are extended in their positioning. So they're all built around 7 or 8 different stocks, right? So these names like Micron are considered small in this regard. You have a lot of money flowing through SpaceX. You have a lot of money flowing through all of Mag 7. They're long U.S. Treasuries. So tactically, if interest rates go up, that's bad for yields. They may have to dump some bonds. And all of these equities, particularly in the NASDAQ technology, are packed long. So right now, as we look at this, this is an unwinding potentially that could occur. And if that is the case, we start to look at the potential leverage in this market and whether or not funds have to sell. Not whether or not they think that stocks are expensive, but if they're forced to sell over the next couple of days. And of course, tomorrow, Mark, being triple witching, a critical day for options, futures expiration, and a lot of other big names.
Yeah, Garrett, on that news, we talk about these chips. SMH went from, look at this chart of SMH.
Mm-hmm.
From 637 on the low, it dropped to below 625 and has now rallied back to 632. So that caused a 14-point swing in chips.
Correct.
Now, I took people through how you get to interest rates affecting chips, but there's about 3 or 4 steps before you get there. And I'm not sure that what I think this shows is the leverage in the market around chips more than how interest rates affect chips themselves.
So the other thing that's important, what were they piling into ahead of time? Semiconductors, the number one favorite, the allocation at a record high, particularly the Samsungs and Korean names that have seen significant leverage in the market. In addition, financials and industrials. Look at what just happened to the XLF. That was, that's not normal. Just so everybody could see it. That's a pretty good little drop in one candle in terms of deviation lines, right? A move pretty much down to the 3rd standard deviation. So just so that everybody understands, a movement like that only is supposed to occur somewhere around 1.5% of the time. So that's what we just witnessed. And this is, again, the way that these markets are increasingly functioning. You're seeing a lot more on leverage. You're seeing speed in this market. You're seeing basically funds that were positioned, and now a quick move you've just seen. Do they have to sell? Well, they effectively unwound certain positions that quickly. And now the question is there a continuation of that trend? And if it starts a new trend, then it usually is a period of lower highs and lower lows. This was very crowded. And of course, government bonds, very strong tactical longs, which is why the TLT will be so important as far as we watch trends for today. Right now, we're kind of range bound at around the 74.80 level, and this is going to shake out over a period of 2.5 hours. Funds don't sell all at once, and one of the key reasons why they don't, you just saw it. When we see a significant amount of dumping of something into the 3rd or 4th standard deviation of price, guess who steps in and buys it? Robots with no soul.
Yes. And to be fair, most of those hedge fund guys have no soul as well.
True, but the other point, but again, they're also buying mechanically. So once again, a lot of this comes down to Do I have to buy it? What does my prospectus say? And if there are just rules that say you have to follow a specific action, that's what they're doing. They're not doing it based on fundamentals. They're doing it entirely based on tactical decision making. So now the SPY trying to fight back. We're above we're moving into the second standard deviation of price. This is where it's not going to be shocking to me if this starts to rally a little bit and then gives back over a period of time. But this is a lot of chop for 5 minutes or 15 minutes. Really now, but our focus really needs to be built around is what happens when Warsh speaks. And if this market stays down here, if there is one or two things that he can just throw a bone to this market, will it actually continue its trend of moving higher? And as we've seen, markets will move higher despite inflation expectations.
Oh, for sure.
They don't care. That's not the real big story. At the end of the day, this is about the plumbing of the financial system, the value of the bonds, the assets that are, effectively being leveraged, and whether or not those positions can be sustained. And that's what we're looking at right now. We're near that 7,500 level. If we bounce off that 7,500 level and we roll lower, then that's a sign of what is to come.
Well, and looking at yields, nice massive pop in the 10-year. It tried to break back over 4.5. It's starting to give some of that away. The 2-year, they're gonna make me put a 0 there, aren't they? Yep. 2-year similar price action. I mean, 2-year. Look. Why are we? That's a lot of volatility for a 2-year bond.
It is.
Like that's pretty aggressive, and the strength in the 2-year is really killing the demand in the 10 and the 30. Right? Why am I getting a 30-year for 5% when I can be playing the 2 for when I can play in the 2 for a 4.13 yield?
Right. Well, why even bother with the 2-year when you could buy the 12-month and it's completely and totally liquid? Everybody will treat it as cash, and the U.S. Federal Reserve is buying it.
Yeah.
So
got that too.
That's where this is really starting to get a little scary for this, because once again, I do want to remind everybody the U.S. national debt will hit $40 trillion in September. So the costs associated with this is exactly where the challenge really becomes. And I want to stress this. This is why Warsh is in a very difficult situation, because the concept of what must be done in a world of ongoing rising debt, you can handle debt when you are even in the face of rising interest rates, but it's very, very, very difficult to manage the rest of your economy while doing that. And it's also very hard to do that in an environment, of course, where the markets are looking for any particular reason to move away from bonds. Right now, bonds are paying a higher yield than stocks for the first time in a very long time. Now the question is, has the market shifted in a way where other investors and traders are trying to speculate more on this leverage position? And keep in mind, a lot of that leverage is born on the back of short-term bills, short-term treasury bills. So the issuance of this, and again, the way that this whole thing operates, it's extremely confusing because most people weren't taught it. If they learned about this stuff back in the 1990s, they don't realize that they rewired the financial system in 2008. And now you have all of this increasing leverage, this forced buying mechanisms that are being brought into the market. And that is making the job even more difficult. And on top of that, as these other stocks rise the way they have been, they are adding a consumer inflationary component to it, because the people who are in the top 10% who are actually driving consumer spending believe that they're richer, so therefore they are spending money now. And as a result of that, you create this self-fulfilling loop that becomes more problematic. Now, one of the things that we did talk about was the dollar. The UUP is moving higher. This is particularly bearish. A higher dollar is problematic given the fact that it is the refinancing mechanism of the world. But that is a big move, especially for that and for the UUP, which, again, we've talked about earlier today. The UUP just jumped 10 cents. If you were just trading something as simplistic as the $28 call that expires tomorrow, that thing just went ballistic. That was probably a 5-cent trade that probably just went to 15. Possibly.
Yeah.
I have to look at it.
Yeah, I mean, this is an aggressive rally in the dollar, which
Yes.
is all right. So dollar up is bad for bonds.
Mhm.
What is West Texas doing?
Down. But the thing that does surprise me about this is, remember the stagflation trade, the thing that you're looking at this, you're saying this is stagflation. Silver and gold are down, right? So that's another thing that everybody was taught. We were taught, well, stagflationary trade, it should be the 1970s playbook. It should be oil and it should be gold and it should be real assets. That's not happening right now.
Yeah,
So
WTI is now, the cash market's down to $75.60 for oil. And, you mentioned gold. That's, what is that, GC? It is. Gold futures. Wow.
Yep.
Wow, everybody.
right. So
We just watched gold go from 4,400 to it's about to break 4,300 in 15 minutes. It's a $100 move. That's 2.5%.
right. So then the other thing that you have to do is look at CME FedWatch, which is assess where the odds are actually moving right now. And this is why this conversation is going to be so critical in about
Yeah.
10 minutes. You look out into October, now you're looking at the possibility of a
wow.
hike around
Garrett,
15%.
huge shift in Fed Fund futures.
Yeah.
Yesterday, the market was pricing in about a 60% chance that we would have at least one rate hike. Even was at about no rate hike or rate drop was about 40%. A second rate hike was a second or third rate hike or more was priced in at a little bit less than 17%.
Yep.
The move now, we now have about the same odds of a single rate hike, but the odds of a second, third, or fourth rate hike are now north of 35%, and the odds of no hikes at all and staying even with where we currently sit, 22%.
Right.
So that is a huge move. And it all went to moving into not just one hike. Like, we didn't see what's fascinating is the odds of one hike didn't really go up. In fact, they went down a little bit. All that shift went to the odds of a second, third, or fourth hike.
Yep. But here's the question for you, Mark, that really is the $64,000 question. When we just sold off in that first couple of minutes, what sold off? Everything, right? Everything. Where did the money go right back into? Semiconductors.
The NASDAQ, yeah.
It went right
SMA.
back into semis. Look at the SOXL. It just went right back into it. L.
Here's
Add an
the
L.
stocks.
Add an L.
Oh.
SOXL. That's the leverage.
Oh, of course. We need the leverage.
Went right back in.
Yeah, so how dare I look at the actual SOX index? What kind of a crazy person am I?
Right. But this is exactly the point. This is where the market, this is the leverage in the system. This is the money that we're really operating on. And this starts to go. And again, the inverse trade on this is the SOXS. And I'm going to jump over to my site right now and see if our momentum signals have moved at all. I would imagine that they have, particularly we have a divergence reading right now on the NASDAQ, which is bearish, and the Russell's still holding up. I don't see how,
Yeah.
but names that are starting to show up. We have BSX Healthcare, CME just showed up again. Devon Energy showed up again. Fiserv, so some of these tech names are starting to show up. So this stuff becomes carry through shorts into tomorrow, particularly. So I would be looking at, shorting something like Fiserv. I would probably be looking at shorting energy still, and then BSX, Boston Scientific Corp. That's kind of where I would sit directionally heading into tomorrow. And this is just lower highs, lower lows. This is just momentum breaking down on a name like BSX. We might get a push up to 46, but the next leg down looks like a continuation down into the low 40s.
You had call sellers of December 60 calls here in BSX today. And then everything else appears to be short dated puts that's hitting the order flow there in BSX.
People are riding this into the ground. It had a bad day and it had a bad start in late May at $50. It's dropped another 5%, 10%. And there's downside. There's a lot more downside here. So the XOSS is waking up a little bit. And if I'm going to go into the end of the day, I probably will look into next week. And that's where I may take a shot. But right now, there's not enough here yet to show too much divergence. The NASDAQ's under some pressure, but
yeah,
financials are holding up. Energy's still weak.
Yeah, I mean, well, that would explain if financials are holding up. That would explain the Russell, right? Because there is a lot of the Russell's basically oil and financials, and then a few tech companies that will be out of it in a year or two, if they're worth their salt. Here's a tip, folks. Very rarely do you want to own a tech company that is in the Russell 2000 unless you have some very specific metrics you're going for, because typically those are they don't perform that great unless you really strategically pick out the right names. So yeah, SOXS, we're seeing, as you said, in that leveraged ETF, it is all over the place. Watch out if we hit these kind of these candle lows that we had on the opening and closing candle from the first couple minutes after they made that announcement, because that could lead to some ugliness, Garrett.
I mean, if I'm going to hedge into tomorrow, then I'm going to do the SOXS. I'm going to look at the $4 call, which is tomorrow, and it's 36 cents. I mean, that's the cleanest representation of this. And that's a move. It would require but this thing's down 8% today. So, I'm looking for, we're going to look and see if we head into that last hour. If there's going to be selling in this market, it's got to be in the semis. And if Warsh says something that everybody loves, then Warsh says something that everybody loves. But it kind of goes back to, you have to really question, like, what's the cleanest representation of where to hedge in this market? And it remains in the crowded trade. It's in the crowded trade, right? I mean, if that's where everything goes, that's where the asymmetric upside is. I'm still long a lot of this stuff. I don't see any reason to really dump any of it over the long term, because I know they're going to print a lot more money. But right now, we're just watching this stuff bleed. We'll see if we bleed off some more, and we'll go from there. As far as the rest of this goes, the thing that is interesting about this, the longer run funds rate stayed at 3.1%. So the Fed is not saying neutral has permanently shifted higher. It's saying that near-term inflation problem has gotten worse. But the destination didn't change, which I think we've heard this term before. It's transitory.
Yeah, transitory.
Right. So core inflation remains the challenge. And the fact that they hiked that core, because once again, that core was not as bad as the headline number was last week. That's the issue. Now, again, everyone can explain away the headline PCE jumping from 2.7 to 3.6. But if core goes from 2.7 to 3.3 for 2026 and up in 2027, they're saying to us that it's not gasoline and crude oil that's doing this. They're saying that core inflation was already happening and that we could potentially see damage. And that's, again, going to go back to services inflation, which has remained persistently high. Why? Because they have consistently kept economic conditions loose for 5 years.
So if I wanted to kind of get a stock that is going to ride the wave of services, what am I looking at? Am I looking at like an Accenture? where would I want to, if I wanted to kind of track what that sector looks like and how it's behaving?
You would have to go into, I mean, if you're focusing on that, it's not going to be commodities. So payment transactions would be one place, right? I wouldn't want to really focus on like HR or payroll because I think a lot of that is threatened by AI. Insurance brokers are insurance brokers technically, right? So that's going to be a major element. Healthcare services providers. So Humana's at the top of the list for a reason. Companies that we like, we just saw Bill Gates buy another $100 million of Republic, which is waste management, right? A rival of waste management. So they're local services companies with pricing power. He owns a ton of that. And from there, I mean, it's going to be cybersecurity. I think that that's one of the last things that people really have to take a deeper dive into to understand that the last element of the AI build out is going to be trust, and it's going to be the cost of cybersecurity. All right, how do I access this guy just talking in my face?
We're gonna get the sound going.
Let's Mystery Science Theater this one.
The Federal Reserve.
That's going to
take up this duty at a time of such consequence. I've been especially heartened by the warm welcome of old friends and new colleagues both. And I've listened closely to my fellow FOMC members, heard a lot of new ideas, new thinking, and genuine interest in moving the Fed forward. This week's FOMC meeting exemplified the very best of the Fed's traditions: rigorous debate, open-mindedness,
get on with it,
mission, responsibility, and accountability for performance. In this business, they all add up to one thing: getting monetary policy right, or as near to it as we can do. That is our North Star. My colleagues and I are here to serve our legislative remit, which you've heard us say before: price stability and maximum employment. And these objectives guided our business in the meeting just concluded. As you saw a few moments ago, the committee,
it's our first Gen X Fed governor.
Fed funds rate at 3.5 to 3.75% in support of the Fed's dual mandate.
I am lining up
The committee
on
also
FinViz
confirmed its policy of
TradingView.
maintaining ample reserves in the banking system.
And we are looking for
activity
direction on the
expanding
SPY
at a
at
pace
3
despite elevated
235.
uncertainty that owes in part to the conflict in the Middle
We're
East.
selling off.
Productivity growth.
I would
and
love to
capital
see this at
investment will strong.
74.50
Job gains
as a possibility for a move back to
The unemployment
7,500.
rate has changed little.
Okay.
Just
We
pure
recognize
algorithmic
that
move.
inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. Persistently high prices are a burden for the American people. But the recent past need not be prologue. I am pleased to report
He really likes his
members
big
of the
words.
FOMC are unambiguous
Ooh.
and unanimous.
Ooh.
This committee will deliver price stability. At any institution, a change in leadership is a natural and timely opportunity to reaffirm its mission, to review current practices, and to consider whether those practices best meet our objectives. My Fed colleagues and I will be working in close collaboration to ask what changes might improve the conduct of monetary policy.
How about doing monetary policy?
You might have already noticed a difference
do your
in the
job.
policy statement.
It's not fine. It's fine, bud.
Shorter, a bit simpler,
He's really enjoying the spotlight
sentences
here.
with some older language.
Sure.
That statement just
It's been
gives
gone
you
15
facts
years.
as best we can judge it.
All right, we're 235. So if I'm doing anything,
Forward guidance.
746 call on SPY, maybe selling 748. But I mean, this is
This
kind of
afternoon,
dull right now.
It is. What do you think of even the tie is dull?
economic projections.
Everything's dull.
It's been the practice of this committee
I mean,
For
If you told me this guy was 40, I would believe you. If you told me he was 75, I would believe you.
so. I, however, have
He's
refrained
got that look.
from offering any projections of my own consistent with my long-held views on the SEP, at least as currently structured. In
He
the
said
median
he said
projections,
price stability. He
rise
did not mention the
2.2%
price
this year.
target of 2%.
2.3% next year.
That's important,
Total PC inflation runs at 3.6%,
which means that they may be targeting 3%.
next year.
Yeah,
The
maybe.
unemployment rate stands at about 4.3%.
And if the market sees that and takes that as
funds rate
the possibility that 3% is the unofficial
this year.
target,
and
this market will
3.6
rally.
at the end of next.
That'd be a quick way to inflate away the debt.
Turn now to a few words.
Well, that's what they've
about
been doing.
Initiative.
That's
Yeah.
what Krugman and Ella Rain at
I'm
were
appointing a
were
task
arguing
force
for about a
aimed
year
at
ago.
5 areas that are
So-
central to the broad conduct of monetary policy.
Again, the
First,
746 is
Communications.
You
now
bought-
running.
Second,
Yeah, if you bought his call, take your money.
I want to
Third,
see this hit
our use
749.
and reliance on existing data sources. Fourth, productivity and jobs in an era of transformation. And last, the Fed's inflation frameworks. These subjects are timely, consequential, and in my view, worthy of a fresh look. My colleagues and I discussed them with energy and purpose over the last couple of days. For each of these independent task forces, I'm enlisting some of the very best minds, both inside and outside the economics profession. They
The
will
more
be
boring this is, the more the market will run
professionals
higher.
from our superb
I agree.
Fed staff.
And this is definitely
748.
boring.
748 on the SPY is my target, and then I'm
This
done.
guy makes
Ask
Powell
your
look like
questions.
Krusty the Clown.
Examine current practice, consider alternatives, and ultimately propose next steps for policymaker consideration.
What's volume doing
Since last
right
summer, my colleagues discussed possible improvements in the form and function of Fed communications.
Can't imagine it's high.
This new task force will build on that effort, and I expect propose some well-considered changes, including to the SEP I mentioned a few moments ago. The second task force, the one on balance sheet policy, will review the benefits and risks of the current ample reserves regime and the composition of the Fed's balance sheet. They will assess alternative frameworks for the conduct and operation of monetary policy. The
I'm
third task
tired. This
force,
is
the one on
why
data
did I study all of this for
We'll
17
evaluate-
years?
I
What
don't
was I
know.
doing? I could have been doing so many other things.
the logical changes to improve data gathering
Economics.
with the aim of
It's
giving
the dismal
policymakers
science for a reason, man.
relevant.
This guy is just putting everybody to
Contemporaneous.
sleep.
Oh my
All
God.
right, you're at if you
Actionable
did buy
information
that 746, congratulations.
Yeah, you're there.
746.
You've
Task
You
force on
have
productivity
snored
and
your way to a nice
So,
gain to the upper band of.
reach the economic impact of new general purpose
We're
technology
looking to move to VWAP at 748, 79, and then you're done.
for the Fed
Yeah,
and
I
And then I'm gonna go just
and inflation mandates.
take a no-dose and
Force, one on
try
inflation
to wake
framework.
up.
like I
Well examined
Yeah,
the
pull it there,
just
740.
skydive.
first
Yeah.
principles.
It's
Wait,
just a boring.
we're-
It's just a boring set.
Delivering price
I mean, the trade took it. It went at 235. Everybody fell asleep. We moved
Yeah.
right back to VWAP.
and this overall initiative in the coming
SPX is approaching that 7,500 level.
Yep. So that's your
been
line
kind of
in
our
the
line in
sand.
the
Yep.
sand.
will serve an objective shared by
Um,
everyone in the system.
You know, if we tap that
Sure,
thing
yeah.
and start to roll over, you might have an opportunity for a
Federal Reserve that
little
is
reversal play
utilized
buying a
just hit it.
play. Yep.
Yeah, I'm pulling that
Focus on the
746.
And with that, I appreciate your attention. I'm happy to take your questions.
That was it.
That was it.
Wow. And now everybody's selling.
It's good to see you
Sell
again.
Mortimer.
Welcome back.
Sell.
This is a lot to be putting in
Buy
mind.
the 747
What
back.
is the timeline
Sell.
that you have in mind for each of these?
So I think it'll depend on the task force. And also
Oh, he's setting up
depend on the
task
urgency in
forces.
which
Oh, we need those. We need a
Different
committee.
stuff.
my expectation, I'm still in the
Nothing
business
ever.
of recruiting and
No,
filing.
nothing solves a problem like a committee.
Expectation is the
No,
task
because this is the
We
thing,
did work
Mark,
in
and I think that this
couple
is
weeks.
actually important.
And we'll
The
start to
reality
get
is,
some
and can we
information
kill the
from
can we
some
kill the
more
audio real quick?
framing of how
Yeah,
they
yeah.
see things.
This goes back to something that we've discussed in the last 8 to 10 months. It's the idea that the Treasury Department is actually driving so much more of this market than a lot of people seem to realize. A lot of people don't realize that, for example, since 2017, we have gone from 11% of our debt being under 12 months, Treasury bills. Okay.
Mhm.
That is now 22%. Why does that matter? It matters because those treasuries are utilized in short-term markets through repo. They are collateralized. They are pledged 3, 4, 5 times, every one of them, by hedge funds who then access capital. Those short-term treasuries are known as cash-like collateral. So they can
Yeah.
borrow on the back of it, right? So every time that repos go into hell, it's because of that funding market, the short-term treasury bill market. What is happening and why this matters, by moving it to the front end of the curve, that helped increase all of the leverage. And if you want to see how parabolic this has gone, look at the stock market since 2017. That's when the practice started. So we've been moving in this almost exponential direction. If we start to move toward 25%, as Bank of America has projected for our short-term treasury bills, that's going to be another massive catalyst for the markets. Again, forced buying, again, all of the elements tied around the basis trade, tied around the ability to take out margin, borrow on cash-like assets. That's bullish. But the other thing about this is the Treasury is getting more active doing some other things. For example, in late March, when people were selling bonds, the Treasury ran down its Treasury General account. That stopped selling. And sometimes in the markets, it's more important to stop selling than it is to try to find new buyers. You take the edges off of the selling. That can create forced buying. That can create a leverage, a wind-up effect that turns into a positive momentum impact. In addition, they've been doing these buybacks. They've been going out 7 to 10 years. They're buying back illiquid bonds, then taking that cash, rolling it over, and issuing at the front end of the curve.
I mean, why are you buying back bonds that have a low interest rate to refinance into short-term stuff just to goose the market up?
100%. And to ensure that some buyer who owns that somewhere is stuck in a position like, may say, Silicon Valley Bank was, or some of the other banks that are holding these assets, that it makes them look insolvent on paper. This market's going right back to where we started.
Probably
749. Again, it's one of these weird little phenomenons that at 235, the market likes to pick a direction and it likes to just burn a little bit. And because the meeting has already started and because the announcement was made, some of that volatility that was associated with the, over the next couple of hours, that's been sucked out. And now what's happening? Well, it's a lot of mechanical action because you've got people buying calls. They're trading zero date right now, probably around the VWAP level, if not around that 750 level. Broker dealers have to obviously step in and buy and make sure they're properly hedged. And we just burn
back
higher.
Volume average price, just for those keeping score.
And I'm happy to be the 746 to 748 guy, and I'll sit here and go, yeah, maybe I should have tried to hold back to the anchor, and the anchor would have been back at around 2 o'clock. And if you're using volume weighted average price and you're utilizing an anchor to try to focus on Fed policy, you want to anchor to the 2 o'clock announcement and then see how this market trades tomorrow. And that's going to be a key line in the sand for VWAP and short-term trading tomorrow tied to zero day. But yeah, we're right back where we started. We are. We've clipped right back to the 155 time, which is where people really should be focusing to get a better sense of where this market sentiment was before the algos started doing anything.
we were 75.17 at the time. You could have bought
look at the
the app
semis.
money.
Look at
You
the
could have bought
semis. Look at the SOXL.
Oh yeah,
It went to 259.
yeah, it's right
So,
back.
The hedge that I had went one way, but the position on the SPY went the other, and one went to from 36 to 8 cents, and the other turns and goes from up like 30-40%. And now we'll see if we do sell off, because we did hit a deviation line. So I will look now at the Spaceman. What did Spaceman do? SpaceX hasn't done anything today. Look at that. It's at VWAP.
One thing well, I'll talk to this offline, but there's a definite pattern with SpaceX behavior that's starting to form. And but yeah, SpaceX is down 1%. S&P starting to roll over a little bit again. If you want to try and short it, you want to wait till SPX gets back below 7,400. Futures are 75.72. So you got a little resistance above at 75.75, which is, there's gonna be some sell orders resting there.
Yeah. The funny thing is, Mark, that the 235 trade used to just be trading the SPY. It's now the SOXL.
Yeah.
It's gone $16 since 235. It was at 246. It went to 260. And again, that's where all the leverage is. That's where all of the funds are. That's just money burning into these positions. This did not exist 4 or 5 years ago.
No.
This is fun. So 257. Yeah, that thing is just pure gasoline. This thing went to, okay, so just to put this into perspective, it went to the third standard deviation on the bottom, and then it went to the third standard deviation on the top. That is a 232 to 260 move. And then now it's starting to roll back over.
Yep. We're below 74. We're below that 7,500 and VWAP. I've
You
got.
want to show that screen? This chart's insane.
It is.
This is
I'll add it back.
What is happening?
This is SPX.
SPX,
Soxel.
SOXL.
I mean, 234 to 260 in half an hour.
Which I would imagine whatever the VWAP. I don't know if I'm going to have the data up yet, but I mean, this is the type of thing that we want to be looking for now moving forward, which is great. And SPXL would be great, but the option chain for SOXL, especially with Third Friday tomorrow. Let me see if this is actually going to pull up.
What are you looking at here?
What I want to look at is the high and the low of the day of the 245 call on SOXL expiring tomorrow.
This is going to be a fun one.
It's going to be hilarious.
All right, the high of the day on that call is $20.10,
And it probably just happened.
Yeah, and the low of the day is $7.40.
There you go.
That is quite the range. You want to know what the range was on it yesterday? The high was $34.55. The low was $66.35.
So again, volume weighted average price trading with leveraged ETFs. This is just, it's funny too, because there's a lot of stuff out there where people will make crazy recommendations and they're like, I like this, random call, and it's a complete and total lottery ticket. There's actual math behind this. There's justification and recognition that you've got deviation lines, you've got algos speaking to one another. You also have effectively the way that this market is managed now. And the fact that people are actively trading this stuff is even wilder, because again, somebody starts buying the 245, some dealer's going to have to step in and buy this thing at 240. And I don't even think that, who said that? Somebody said something this morning, like that I think we were on a call. He said, I'm exposed to everything now. Was that Andrew?
That was doing what?
So we were on a call this morning.
Yeah.
And we were talking about recommendations and ideas. And basically the whole point was the exposure right now is to everything.
Yeah.
That if you're in that position, you have to manage virtually the entire market right now.
That sounds very Andrew.
Yes. So 240.
Just absolutely insane. So Warsh is saying like he may not do a presser every meeting.
Yeah, that's been done in the past.
He said we'll fix 5 years of misses on inflation. That is what he said a minute ago. Quite the statement.
And the market doesn't care.
Yep.
TZA. TZA rolled over, so the Russell's moving up.
Yep.
We're
S&P
well capitalized.
softening up a little bit. Let's see.
Again,
Inflation is primarily determined by monetary policy. Inflation is a choice.
yes. No, inflation is driven by monetary. It's driven by printing money.
Yeah. Yeah. It's driven by printing money, and which is basically monetizing U.S. debt.
Right.
That's really what it is. We have 40 trillion in debt. How much of it has been monetized through the Fed, through the Fed and the Treasury, through
Right.
the actions that they're taking?
Right. Well, you also have to keep in mind that inflation is not just, there is a whole other world of capital that exists, and that world is that capital is created in a different banking system than what you and I are typically used to. And that in itself is where repo operates, where all that capital is, is poured out. But the thing that is odd about all of this, and one of the things that I think is really important to note, we're not going to see it just yet, but keep in mind that you have all of these hyperscalers that are now going out and borrowing money for the first time, and they're going to create, by definition, money. They're going to create money because the issuance of this debt is going to come. A lot of it is going to be off balance sheet, and a lot of it's going to be in the hedge fund and shadow banking space, right? A whole different world than most people. People are looking at me, go, "What are you talking about?" Exactly. Like this is how this functions, and a lot of this debt is created, and a lot of that debt will be traded, and that debt is more capital into the system itself, and that is helping to drive a lot of these AI stocks. Now, will we hit a wall on that? Eventually. Right now, people are lining up left and right to give Google money. People are lining up left and right to give AI CapEx capital. They are trusting that is going to be a massive catalyst, and that is helping to contribute to this. And more people continue to, we just keep crowding into these names. We're going to keep crowding into these names until we have to stop. And we have to stop when the bond market tells us we have to stop.
Yeah. And one of the things that I'm still monitoring is what blew us up a year ago in April, which was the carry trades between Japan and the U.S. and Korea and U.S. You mentioned at the top of the show, look at the Kospi, right, which is the Korean index, and how strong that's been. I haven't looked at the Nikkei in a while, but I'm going to go out on a limb and say it's probably doing pretty well as well. What risks do you see on that in terms of another potential blow up there? Because, one of the things that's interesting is, I do this carry trade. I own U.S. Treasuries, and you can take it a step further. And I know there are firms doing this, and then put those Treasuries up to go play in SMH or stocks, and that is happening.
So there's two components to this. One, you're 100% right. That will exist. That persists for a while. The concerns around Japan and whether or not money actually goes home. If money goes home to Japan, that's a problem. Because that's going to unwind a lot of the leverage here. But you and I had a little bit of a conversation the other day, right? We talked about what's the sector, because while we're talking about the fact that the market is going up, pay attention to the fact that communication services, consumer defensives, real estate, and cyclicals are getting beaten up right now. Right? So it's a bizarre situation because the market capitalization, and I'm going to show you this number right here. This is our pulse number. Our cap weighted number went to negative 109. That's not a good news. I'm just going to point that out. But there's a lot of selling that is persisting right now. That what's up on the week, Mark? What did I choose? Basic materials. Right? Because that's the stagflation trade. Now I get lucky because the Fed shows us that a stagflation trade is in place.
Mm-hmm.
But again, this basic materials is also heavily driving the AI, the refi there. So that's going to be important as well. What did you choose? Real estate.
Real estate, yeah.
Yeah,
And I only
well-
chose real estate because you took basic materials already.
You could have taken basic materials, or we
well,
could.
that's not a bet. I'll bet
But
you
we
the Cubs
could've-
are going to
we
win.
could've-
Oh yeah,
we
I'll
could've
bet you
gone-
the Cubs are going to
We
win.
could have gone further down, man. We could have gone into basic materials, and I would have taken coking coal or chemicals. I would not have taken silver, even though it's up 27% this week. So, that becomes a broader issue, is that the breadth of this is very concerning as well. Now, the S&P 500 has pulled back. Now we're down on the day, but
Mhm.
And it also lends itself. I do want to remind, we're heading into the last hour, so you want to pay attention to something like the 3-minute chart. And if we start to break under that 8 and that 20-day adjusted, this can roll over very, very quickly as well. We get a squeeze and then we get a rollover. And then once again, the SOXS suddenly comes back into play, because what we might have gotten was either short covering or just that one last pump that everybody looks for in order to sell back into that pressure.
roll it back over.
Yeah.
Garrett, you mentioned chemicals. There was some pretty big put spreads being bought in Dow Chemical today.
Huh.
They bought the July 10 31.27 put spread, and they bought the August regular 30.27.5 put. Total about 12,000 put spreads between the two of them.
This is a really great looking chart, Mark, for downward direction.
Yeah.
Because look at the trend, look at the lower highs and the lower lows.
Yep.
So that actually is pretty intriguing. I like the idea of trying to target that 32 into maybe next week. So in that case, if people are looking for a trade, something that would be simple to do is you could buy the 34 put for next week and you could sell the 32. You could buy the 34 for tomorrow and sell the 32 if you wanted to do it directionally. But the reason that I'm making that recommendation is that's giving you a little bit of cushion, just simply because we are back above our 20-day moving average. And, we might see some people trying to protect that level tomorrow, given that it is Third Friday. Or
Yeah.
it's not Third Friday, it's triple witching.
Triple witching, quadruple witching, whatever you want to call it.
Quintuple witching. I'm just going to dress
Well,
up like a witch.
Because it's index options, index futures options, and equity options.
Yep.
And futures options have become a major thing. When I was on the floor, we just kind of ignored those, except for S&P, and now they're pretty active. And there's a lot more of them.
I'm going to hang out. I'm going to give you I'm going to give you an update at 3:00 to tell you where our figures have gone.
Okay.
Because what I'm watching right here is this cap weight. That is daily momentum and monthly momentum. So what we're seeing is everything else outside of this market under some pressure. And if the big names start to sell off today and this goes negative, we have divergence heading into tomorrow, which tells me that we could get you're going to see a lot of wild moves tomorrow. And what I'm projecting is you're going to see a move down very sharply and we end up on the day, or we're going to move higher at the beginning and then we're going to sell off into the day. There's going to be a lot of games being played tomorrow.
I mean, we all know that the market will reveal itself when he's done talking.
Yes.
And the fact that we're down 40 at 43 and he's still talking, feels like we could get a rollover.
Well, we're seeing it, and my question is again that ridiculous SOXL bet that we talked about, right? The $6-7 low, and then 20 something, and now all of a sudden that thing might be back at 10.
Yeah,
it just shows you how violently this stuff is moving. And once again, what I try to look for is some sort of rollover on this line, which is the 8 and the 20. And we just saw a tap on the that's a 300-minute line.
Mm-hmm.
I mean, tomorrow's going to be really interesting. But once again, this is the type of stuff that I think that, as we do more of these and we have these conversations, you have to be looking for these crazy reversions and you have to be willing to take small bets.
So
because
Garrett,
the way some of this stuff moves today is just crazy.
What's the what was our price range in stock in SOXL today? The low was
I think it was like 657, and then the high was 20
the
something.
low was 234.34
Oh, for the 245?
for SOXL.
For the for the
No. I'm giving you the price range.
Yeah,
All right,
yeah.
the low
It fell to 234.50, and then it popped to 260-ish.
Yeah, the high is
Now that's just the SOXX, just so everybody knows. It's just a levered version of it. But the
I'm
SOXX
looking
jumped.
at SOX. So the low was 234. It was. I don't know why this isn't giving me the price.
We
There
have
we go.
divergence. That's bearish.
Yeah, the low was like 234. The high, as like you said, 259.80. Do you know how much they'll sell you the 250 straddle for?
You tell me.
$20.
Phew. All right.
Average true range on this thing. Would you like to know what the 10-day running average true range is, Garrett?
I mean, I got the 14 sitting somewhere. Yeah, go ahead. What do you got?
The 10-day average true range on SOXL, $36.21.
Yeah.
They have these things probably, if you made me either buy or sell that straddle, I'd be a buyer.
Yes.
I'd be a buyer 100% of the time.
June 9th, this thing hits the 50-day moving average and bounces right back like a ping pong ball to 280.
Yeah.
That's where we are. And this is what
All right. Garrett,
people are trading.
It is 3 p.m., 3:02 p.m. Do you want to give us our quick update, and then we'll kind of wrap things up?
Yeah. So right now, what we're seeing is divergence in this market right now. This is pretty bad, to be honest with you. That is an equal rating of short-term momentum, daily versus monthly, and we're seeing our equal weight and our cap weight very negative. So what this signals, even though we have these very positive numbers, what we are looking at is the possibility of an increasing probability, like a much higher probability of a reversal. What we're seeing right now is a lot of hedging to the upside. So right now, again, it is still likely cheap to buy the insurance. I would be very, very interested, of course. The VIX didn't do anything today, by the way. Keep an eye on the UVXY, everybody. As we wake up, we'll see if we get above that 8-day moving average tomorrow. We may retest this 30 next week, and we'll go from there. One last thing I want to look at. FNGD did not do anything. So that's good. That means leverage has stayed in the market. The banks, FAZ, has actually turned negative. So the DPST is what I told everybody to look at. Regional banks got beat up pretty bad.
Garrett, I'm going to leave by giving everyone a fun little hedge.
Fun hedge.
UVIX.
Yep.
This is what UVXY was originally designed as. It's 2x long, the VIX futures. Expires tomorrow, so it's looking at July futures. On the day, July futures are up. They're up about 38 cents. UVIX is up. It's $3.40. It's up 4%. The 3.5 calls are a nickel for tomorrow. And if we come in and we're down 100, UVIX will make a serious run of $4. It can move that quickly.
Yes.
So might be a fun little play if anybody's interested in hedging their hind end overnight.
250 call you could probably do for about 75 to 80 cents. So that's going to end up being less than the value of the UVIX right now. The break even would be 330 if you can pull it off. 335 would be acceptable too. And if you do get that bump in volatility, that way you're just in the money. That's another way to do it as well.
Absolutely.
All right, Mark. Well, we have one down, man. We've got many to go this year. So thank you very much. I know tomorrow is your Super Bowl with Triple Witching. So we will check in. I want to thank everybody for taking the time to join us today. Hope you learned something. If you didn't, well, that's on you.
Absolutely. All right, Garrett, thanks again. I know everyone's really happy that you're here. And and I'll just say it's a lovely reunion.
Yes, it is.
So, folks, for Garrett Baldwin, I'm Mark Sebastian. I am your only option. Garrett will see you tomorrow at 9:20 a.m. Make sure you're there. He is just giving you great ideas every single day. That's 9:20 a.m. here every single day, right before leading into the State of the Market show. All right, guys, have a great day.
Good to see y'all. Take care.
Bye.